Welcome to today's Daily Brief. Look, if you've been riding the market waves recently, you already know the waters are getting incredibly choppy out there. So today, we're focusing on a really crucial dual strategy. We're going to look at how to stabilize those volatile, tech-heavy portfolios, and just as importantly, how to navigate the hidden market mechanics that constantly trip up retail investors. Okay, let's dive right into this explainer and figure out how we can protect your capital while setting you up for some really smart calculated entries. Here's our quick roadmap for today. First, we're tackling the volatility problem. Second, we're looking at two forever stocks. Third, we'll expose the algorithm trap. Fourth, we'll cover timing your entry. And finally, we'll wrap up with portfolio strategy.
All right, let's jump right into section 1, the volatility problem.
So the core dilemma facing almost every investor right now is pretty clear. A massive, literally massive, amount of capital is currently heavily overweighted in artificial intelligence. And don't get me wrong, the AI sector offers immense growth potential. But as we all know, that kind of hypergrowth comes with extreme volatility. When the market turns, these top-heavy portfolios suffer some really dangerous drawdowns. Remember, a drawdown is your maximum loss from the highest peak. To survive this kind of environment, you desperately need stabilizing assets to act as a shock absorber for your overall portfolio.
Which brings us to section 2, two forever stocks. Now, we can't just pick any random stock to stabilize our AI gains, right? A true forever stock actually has to meet 5 very strict fundamental requirements. First, we need a highly predictable business model. Second, we need growing long-term revenues. That predictability ensures our third requirement, which is stable, positive cash flow. But what are they doing with that cash? Well, fourth, they need to have active share buyback programs. And finally, fifth, they absolutely must offer a competitive dividend yield when compared against the 10-year U.S. Treasury. We are looking for bedrock stability here.
Based on those really strict criteria, we've landed on two titans in the consumer staples sector. We're talking about Coca-Cola, ticker KO, and Monster Beverage, ticker MNST. Now, these two names brilliantly illustrate two very different flavors of stability. Coca-Cola is your classic heavyweight. It offers a super steady 7% annual profit growth and a fantastic dividend yield. Monster, on the flip side, is a total growth beast within the staples sector. It boasts spectacular revenue growth of over 20%. Plus, Monster executes what you can only call monstrously aggressive share buyback programs, which constantly reinforces its upwards trend. So fundamentally, both are incredible options. But here is where things get a bit tricky. Let's move to section 3. Beware, the algorithm trap. You see, even if you find a stock with absolutely perfect fundamentals, like Coca-Cola or Monster, buying it at the wrong price can turn a great company into a totally terrible investment. You really have to understand a market mechanic known as stop hunting. This happens when Wall Street's algorithmic systems intentionally push prices around to trigger retail stop loss or buy orders. Why on earth do they do this? Well, institutional players need massive liquidity to enter or exit their own giant positions, and they use your predictable orders to get it. They essentially use your safety net as their launch pad. Or, to put it bluntly, they do it to steal your lunch money. Let's look at how this builds into a very specific, totally repeatable trap. Step 1. The algorithms push the price just barely above a known resistance level. Step 2. Retail traders, who are reading all the traditional technical analysis books, see a breakout and they start placing their buy orders. Step 3. Bam. Once the algorithms have sucked in all those eager buyers, they engineer a sharp, violent reversal downward. This triggers everyone's stop losses and violently shakes out the weak hands. Finally, step 4. When the retail selling is totally exhausted, the smart money steps right in and buys at a discount. They are literally using your buy order to create the top and your stop loss to create the bottom. It's wild. Okay, so now that you know the game being played, let's look at section 4, timing the market entry. Let's apply this exact theory directly to the charts. Take a look at this timeline of Coca-Cola's recent price action. This is literally a textbook algorithmic trap. On May 19th of 2026, Coca-Cola hit a local high of 82.13. Then, right around June 10th and 11th, the algos pushed the price up to 83.50. Retail traders cheered the breakout, they bought in, and then came the violent shakeout, slamming the price all the way down to a low of 78.74 on June 18th. But they weren't even done. In late June, the price bounced back to 81.39, which was a previous resistance area, trapping short sellers before getting violently rejected again. The algorithms are systematically wiping out both sides of the trade. So, what's the takeaway here? You can never, ever buy blindly just because an asset hits a support zone or a target price. You absolutely must wait for confirmation that the algorithms are done hunting. You want to look for a clear pattern of exhaustion. That's a sign that the selling pressure has completely dried up. Or, alternatively, wait for a simple moving average crossover to the upside. The point is, you have to let the institutional algorithms finish their little game before you place your chips on the table.
Now let's compare that whole situation to Monster Beverage. What is super fascinating here is that Monster's chart is showing much stronger relative technical momentum than Coca-Cola right now. It's currently sitting right at a major resistance level right around 95.75. But here is the absolute key takeaway. Monster hasn't sprung its algorithmic trap yet. We are watching this one very closely for a false breakout above 95.75, followed by a sharp drop. Why? Because that specific shakeout is going to be our signal to start looking for an entry. All right, we have our stocks, and we know exactly what traps to look out for. Let's pull this whole thing together in our final section, ETFs and portfolio strategy. If you only remember a single number from this entire explainer, please make it this one, 5%. That is the absolute maximum allocation of your total portfolio that should ever be dedicated to this stabilization strategy. The whole goal of using consumer staples is to act as a shock absorber against tech volatility. They are not supposed to be your primary growth engine. If you go heavy and allocate more than 5%, you seriously risk dragging down the overall performance of your entire portfolio. Remember, in this game, risk management is absolutely everything. So how exactly do we divide up that little 5% slice? Well, because Monster Beverage is demonstrating much stronger relative technical momentum, we actually want to overweight it just a bit. So within that strict 5% allocation, we're looking at dedicating 3% to Monster Beverage, leaving the remaining 2% for the steady, reliable dividend power of Coca-Cola. It really creates this perfect internal balance of growth and stability. And to make this super actionable, here is your ultimate cheat sheet for target entry zones. These are the historical support levels where the risk-to-reward ratio finally aligns in our favor, but only after the algorithms have done their damage, of course. For Coca-Cola, we're watching this 75 to 76.30 zone. For Monster, assuming that trap drops the price like we expect, we're looking at 83.32 to 84.76. And hey, if you're someone who prefers broad exposure rather than picking individual stocks, the U.S. Food and Beverage ETF, ticker PBJ, has an entry zone sitting between 42.36 and 43.60. I do want to take a really quick detour for our international viewers here. We know European regulations often block access to US-based ETFs like PBJ, but there is a totally fantastic alternative out there, the IUCTF ETF. It holds the required European UCITS certification, it boasts an incredibly low 0.15% management fee, and it actually overweights Coca-Cola at about 10.5% of its total holdings. So it's just a great regulated way to apply this exact same strategy without having to deal with the headache of individual stock picking across borders. Which brings us to our final thought for today's brief. The market, as we've seen, doesn't care about your feelings, and those Wall Street algorithms are actively hunting for predictable retail trades. But you know the strategy now. Find your stable forever stocks, patiently wait for the algorithmic trap to completely exhaust itself, and strictly cap your allocation. So I'm going to leave you with this one vital question. Is your portfolio actually protected against the next algorithmic shakeout, or are you sitting out there completely exposed to the next big tech drawdown? Take a really hard look at your risk management today. Thanks for joining me on this daily brief, and stay sharp out there in the markets.